Hey guys, welcome back to another stream today. So it's been a while, been busy with some schoolwork and also was sick, but feeling a lot better now. This stream, got some catching up to do. Lots of tech companies are releasing this week and next week as well, but Analog Devices, Wix.com, Cadence Design Systems, Arista Networks. Last week we had Applied Materials, Cisco. So a lot of these infrastructure technologies, more so on the hardware side when you look at Analog Devices, Cisco, Arista, Cadence Design Systems, EDA, electronic design, automation, software, but it seems like they're also becoming a quote-unquote, I was about to say Cisco company, but a systems company. So starting to see some diversification in their revenue streams as well. Wix.com, I think they can be compared to a Squarespace, maybe even a Shopify, although Wix focuses more on the front end, building a website, and doesn't, to my knowledge, handle a lot of the back end transactions if you were to host a e-commerce website. I think Blackbaud was another one, Baidu yesterday as well, the Chinese Google, so to speak. So we've had a lot of tech earnings. I think from the early on earnings call I was listening to for Analog Devices, it seems like the vibes are improving, especially for the industrial and automotive segments. I think Analog Devices, it's in the name, they make analog chips, similar to maybe what Texas Instruments does, analog and mixed signal. If you think about Intel, AMD, NVIDIA, these companies typically make digital chips, which are using binary ones and zeros, but I think Analog Devices, they actually have some type of continuous stream of data storage. I don't know if that's the right way to put it, but I think this works really well with applied industrial applications where you're working with frequencies, signals, typically found in telecommunications workloads, I think manufacturing, temperature-related workloads, so that could lead into energy, utilities, a bunch of end markets. Driving, I think, is also very interesting because you need to take into account, I think, the energy you're using to actually move your car. With EVs especially, I think there's probably some type of energy component, energy efficiency component. And then also with self-drive, I'd imagine there's probably some type of digital chip involved. I think Tesla has their own digital chip. Intel also is releasing, I believe, their autonomous driving fleet of products. So lots to take in there. I think I'm just rambling at this point. Let's try to dive into the actual earnings release and then also the earnings call. So I'm going to take a look here, the web schedule, transcript, Form 10Q. This is pretty quick. All right. Analog Devices reported earnings yesterday on February 2025 for their Q1 fiscal 2025 quarter. Q1 fiscal 2025. So this is, I believe, from October 1st, 2024 to December 31st, 2024. Could be wrong, but let's. Analog Devices is a call it Fab Light chip designer and manufacturer. Semiconductor, focusing on analog and mixed signal chips. Okay. So this consensus expectations going into the earnings call. I want to say mild, double check. Analog devices beat on revenue and EPS forecasts and guided above consensus expectations for Q2 2025. The management team is starting to see analog devices is starting to see believes the slowdown in analog chips has bottomed and a new upcycle started, driven by, I believe they said, self-driving data center build-outs and industrial spending. I don't know exactly. Let's take a look, double check. Okay, web schedule. Edited transcripts, okay. Q quarterly report. Got it. All right, let's take a look here. More than 2.4 billion sequential growth in industrial, automotive, communications, double-digit year-over-year growth in consumer. Cash flow of 3.8 billion, free cash flow of 3.2, so about 600 million in capex. Trailing 12-month basis. Raised quarterly dividend 8% to 99 cents on the dollar. 21 consecutive years of increased share purchase authorization by 10 billion, bringing total remaining authorization to approximately 11.5 billion. Wow, okay. So it's about half of what was remaining. First quarter revenue, profitability, earnings per share above the midpoint of our outlook despite the challenging macro and geopolitical backdrop. Vincent Rose, CEO and Chair. Recovery is being propelled by improving cyclical demands and numerous new wins across our franchise converting to revenue. Bookings continue to show gradual improvement during the first quarter with strength in industrial and automotive positioning us to grow sequentially, so I guess that's quarter over quarter, and year over year in our second fiscal quarter. We remain confident that fiscal 2025 represents a return to growth for analog devices. All of this culminating in to the confidence that statement. We remain confident that fiscal 2025 represents a return to growth for ADI. Okay, so this is a $2.4 billion business quarterly, so that is around a $10 billion run rate. So 4% decline year over year. Just the results, net cash generation, percent of revenue. So 47% free cash flow conversion. 40% free cash flow conversion. So the gross margins are actually pretty strong. Operating income, operating margin. So maybe they're doing some working capital stuff. And probably a lot of this operating income then is depreciation or amortization. Just the gross margin, I guess it's probably non-GAAP. Okay. Forecasting revenue of 2.5 billion plus minus 100 million as a midpoint for this revenue outlook. We expect reported operating margins of approximately 24.2%, which is above Q1, and I guess sequentially it's hard to make that comparison. Okay, so this is pretty close to what Q1 2024 was. Let's EPS to 97 cents. Supersedes dividend payouts. Okay. Excluding certain acquisition-related expenses. Current and prior period acquisitions, and primarily includes expense associated with the fair value adjustments to debt, property, plant, and equipment, and amortization of acquisition-related intangibles. Okay, which include acquired intangibles such as purchase technology and customer relationships. Expenses also include fair value adjustments associated with the replacement of share-based rewards related to the Maxxing integrated products. Okay. So some SBC, I think some impairment, special charges, and net. Okay, gross margin. So R&D is their biggest selling expense, it seems like. I didn't realize amortization of intangibles is that much. Maybe there's a lot of patents that protect analog devices technology. I guess that makes sense for a semiconductor design company. Okay, interest income. So they are, it seems like, okay, 2.3 billion cash, total current assets, 47 billion. A lot of that does come from goodwill. Accounts payable, debts, accrued liabilities, it's a lot. I guess maybe payroll and long-term debt, so about 7 billion in long-term or just total debts. Deferred income taxes, I'm surprised. I don't know why that's so much. Okay, cash flows from operating activities. Okay, a lot of their expenses does seem to be amortization of intangibles, depreciation, changes in operating assets. Okay, they don't seem to spend a lot on plant property and equipment payments. So it seems like they're just refinancing. Industrial, okay. Ship 2. Okay, I'm going to take a look then at, I actually have the webcast pulled up, so I'm gonna play this from
of
the
Investor
beginning.
Relations and Division Controller of Data Center, Energy, and Power. Sir, the floor is yours.
Thank you, Daniel, and good morning, everybody. Thanks for joining our first quarter fiscal 2025 conference call. With me on the call today are ADI CEO and Chair Vincent Roche and ADI CFO Rich Puccio. For anyone who missed the release, you can find it and related financial schedules at investor.analog.com. On to the disclosures. The information we're about to discuss includes forward-looking statements, which are subject to certain risks and uncertainties as further described in earnings release and other periodic reports and other materials filed with the SEC. Actual results could differ materially from the forward-looking information, as these statements reflect our expectations only as the date of this call. We undertake no obligation to update these statements except as required by law. References to gross margin, operating and non-operating expenses, operating margin, tax rate, EPS, and free cash flow in our comments today will be on a non-GAAP basis. These exclude special items. When comparing our results to historical performance, special items are also excluded from prior periods. Reconciliations, all these non-GAAP measures to the most directly comparable GAAP measures, and additional information about our non-GAAP measures are included in today's earnings release. All references to earnings per share are on a fully diluted basis. And with that, I'll turn it over to ADI CEO and Chair Vincent Roche.
Thanks very much, Mike, and a very good morning to you all. Well, first quarter revenue, profitability, and earnings per share all finished above the midpoint of our outlook. And while we continue to operate in a challenging macro and geopolitical environment, our first quarter results and outlook for double-digit year-over-year growth in our second quarter builds my confidence that 2025 will be a year of growth. Our track record of resilience and profitability through cycles, combined with our strong balance sheet, supports our long-standing robust capital return program. I'm delighted to share that we've increased our dividend for the 21st consecutive year, and that over just the past 5 years, we have returned more than $16 billion, or roughly 15% of our current market cap, to shareholders through dividends and share repurchases. Turning now to our operating environment, the magnitude and duration of this most recent semiconductor cycle has surprised many of us. But we believe ADI has entered and is well positioned for sustained recovery. Throughout the cycle, we invested diligently to enhance and leverage our hybrid manufacturing model to support the dynamic needs of our customers, both big and small. We work closely with our customers to be responsive to their evolving business needs and map factory starts to true end demand.
Factory starts. Okay.
As a result, inventory levels have largely normalized, and our partnership approach with our customers throughout the volatility of the past several years has enabled us to balance supply and real demand. While the macro backdrop will continue to influence the pace of our recovery, the signals we monitor, from lean channel inventories to gradual bookings improvements over the past 18 months, support our view that we've passed the cyclical trough and the tide has turned in our favor. Throughout the cycle, we've been busily deepening our customer engagements and accelerating our pipeline growth and conversion. Many of the design wins I've shared on recent calls are now contributing to growth. And let me give you some examples. For example, in industrial automation, the shift towards decentralized intelligence to enable modular manufacturing is driving significant growth in software-defined connectivity solutions. Our software configurable I/O products that double channel density and reduce power consumption by 40% have been installed across all major automation suppliers. Revenue from these wins has begun ramping as the automation market begins to recover and will provide a durable revenue stream over the next decade. Within the growing surgical robotics segment, increasing levels of content from across our portfolio, and in particular, our high-precision solutions, are being deployed in next-generation surgical systems. And additionally in healthcare, the growing interest in a data-driven approach to health and wellness is creating a convergence of the clinical and consumer markets and driving demand for higher performance vital signs monitoring in consumer wearables. Our suite of high-performance sensors, signal chains, and efficient power solutions, and wins at leaders in these markets position us for double-digit growth this year. Within the automatic test equipment market, the growth of AI has significantly increased our signal chain and power content, in some cases by up to 300% across memory test systems. Customers are leveraging our solutions to increase channel density and throughput while reducing power demands by up to 30% per system. In light of increased hyperscaler capex, we expect our 2025 memory and high-performance compute test revenue to achieve strong growth. In our broad aerospace and defense portfolio, our modules, which support ASPs often into the hundreds of thousands of dollars, are expected to lead double-digit growth in this industrial subsector in 2025. In addition, we're anticipating growth this year from newer design wins in RF and power in the military and commercial satellite sectors. In automotive, the convergence of trends ranging from autonomy to electrification to immersive in-cabin experiences continue to drive robust demand for many of our solutions. For example, our GMSL portfolio is outpacing the growth of advanced driver assistance systems and is positioned to reach yet another record-breaking year in 2025. Since acquiring this video connectivity technology in 2021, our revenue has nearly tripled. We're also anticipating continued record-setting revenue from our A2B and functionally safe power franchises, which share similar growth trajectories. Lastly, in electric vehicles, BMS is poised to return to growth in 25 after a challenging prior year. Part of this growth is coming from our higher content wireless solution wins, with key OEMs ramping in America and Europe. In communications, our growth is predominantly being driven by robust capex investments to support AI infrastructure buildouts. Our high-precision electro-optical controller is now shipping in a 1.6 terabit optical module for AI systems based on industry-leading GPUs. On the power side of the data center, we're delivering high-voltage power path protection systems, which are on a strong growth trajectory,
Seems like there's a lot of
and we'll begin shipping our vertical power solutions later in this year. Finally, in consumer, design wins secured in recent years at multiple customers across numerous applications, including premium handsets, hearables, wearables, and gaming systems, began to drive robust, diversified growth in the second half of fiscal 24. With even more content in upcoming launches, we expect a strong year ahead and beyond in consumer. Collectively, we anticipate these combined cyclical and idiosyncratic trends to return us to a solid growth path this year. So in closing, the relatively favorable position in which we find ourselves, coming out of one of the worst downturns the industry has ever experienced, is not by chance, but rather a reflection of our fiscal and operational discipline, commitment to the success of our customers, and our investments for the long term. And while I'm excited about our prospects for 2025, I'm even more excited about the longer-term opportunities across numerous concurrent secular growth areas, including automation, digital healthcare, electrification, automotive, data center, and many, many more. A common request from our customers across our many diversified applications is that we help them tame the increasing complexity by bringing more complete solutions to them, a reflection of our robust technology stack and stellar customer reputation. In stepping up to our customers' challenge, we continue to push the edges by investing vigorously in our world-class analog, mixed signal, and power portfolios, and integrate higher levels of supporting digital and software into our solutions to meet our customers at the application layer. And so with that, I'd like to pass the call over to Rich.
Thank you, Vince, and let me add my welcome to our first quarter earnings call. First quarter revenue of $2.42 billion came in above the midpoint of our outlook for a 1% sequential decrease and a 4% decline year over year. Adjusting for the extra week in our fiscal Q1 2024, however, our Q1 25 performance represents a 4% increase in our first year-over-year growth since Q2 of 2023. Industrial represented 44% of our first quarter revenue, finishing up 1% sequentially. The improved customer inventory backdrop is benefiting each of our industrial subsectors. In addition, we are seeing stronger demand in our automatic test and aerospace and defense businesses, each of which were up year over year. Automotive represented 30% of quarterly revenue, finishing up 2% sequentially. Our leading connectivity and functionally safe power solutions were each up double digits year over year once again, reflecting secular content growth and greater share position. Communications represented 12% of quarterly revenue, finishing up 6% sequentially. Wireline, which makes up roughly 2/3 of our total communications business, was up double digits sequentially and year over year, driven by data center infrastructure build-outs fueled by AI demand. Conversely, our wireless revenue continues to see demand challenges. And lastly, consumer represented 13% of quarterly revenue, finishing down 15% sequentially, reflecting seasonal weakness. Our second consecutive quarter of robust year-over-year growth reflects our greater share and stronger content position across a diversified list of applications. Now on to the rest of the P&L. First quarter gross margin was 68.8%, up 90 basis points sequentially, driven by favorable product mix. OpEx in the quarter was $687 million, up $32 million sequentially, resulting in an operating margin of 40.5%. All told, non-operating expenses finished at $58 million, and the tax rate for the quarter was 11.8%. All told, adjusted EPS was $1.63 at the high end of our guided range. Now I'd like to highlight a few items from our balance sheet and cash flow statements. Cash and short-term investments finished the quarter at $2.7 billion, and our net leverage ratio decreased to 1.1. Inventory increased $27 million sequentially as we replenished the die bank of our fastest turning products. Days of inventory increased to 176, while channel weeks moved lower and remained below our target of 7 to 8 weeks. Over the trailing 12 months, operating cash flow and CapEx were $3.8 billion and $656 million respectively. We continue to expect CapEx for fiscal 25 to decrease from 24 and fall within our long-term model of 4 to 6% of revenue.
Sure.
Free cash flow over the trailing 12 months was $3.2 billion or 34% of revenue. And during the same time period, we have returned more than $2.4 billion to shareholders through dividends and share repurchases. As a reminder, we target 100% free cash flow return over the long term, using 40 to 60% for our dividend, with the remainder used for share count reduction. As Vince mentioned, we announced an 8% increase to our quarterly dividend to 99 cents from 92 cents. In addition, our board has authorized an incremental $10 billion for share repurchases, resulting in roughly $11.5 billion of remaining buyback potential under our current program. Now moving on to guidance. Second quarter revenue is expected to be $2.5 billion, plus or minus $100 million. On a sequential basis, at the midpoint, we expect industrial to lead our growth and automotive to grow, while communications and consumer decline. Operating margin is expected to be 40.5%, plus or minus 100 basis points, flat sequentially due to a notable uptick in variable compensation. Our tax rate is expected to be 11 to 13%, and based on these inputs, adjusted EPS is expected to be $1.68, plus or minus 10 cents. Before passing it back to Mike to begin our Q&A session, I'd like to address the near-term backdrop. Overall, our business continues to improve off our Q2 24 trough in what continues to be an uncertain macro environment. We saw further order improvement and a positive book-to-bill during Q1. Importantly, booking strength was driven by industrial and automotive, our two largest end markets. Given this trend and the exciting product cycles Vince described, I'm confident we will return to long-term model growth in 2025 and believe we are well positioned to capture additional upside should macro conditions improve. Over to you, Mike.
Thanks, Rich. Let's get to the Q&A session. We ask that you limit yourself to one question in order to allow for additional participants on the call this morning. If you have a follow-up question, please re-queue and we'll take your question if time allows. With that, we have our first question, please.
For those participating by telephone dial-in, if you have a question, please press star 11 on your phone to enter the queue. If your question has been answered and you wish to be removed from the queue, please press star 11 again. If you are listening on a speakerphone, please pick up the handset when asking your question. We'll pause for just a moment to compile the Q&A roster. Our first question comes from Joseph Moore with Morgan Stanley. Your line is open.
Great, thank you. I wonder if you could talk about the puts and takes in the auto market. China seems to be the strongest region. Can you talk about how that affects you guys if there is an ongoing shift in the center of gravity towards China? Does that have any impact on pricing margin or TAM potential for you guys?
Sure, Joe, I'll take that one. This is Rich. So let me give you a little color on what we're seeing in auto. Starting with Q1, revenue came in better than expected, driven by Asia, which we've talked about, continued strength in China. As we've talked about in our recent calls, we have flagged that we have stronger share and content position at major Chinese EV OEMs with multiple products, again, including our audio and video connectivity solutions, functionally safe power, and BMS. And this is coming through in results, and we expect it should continue into Q2. As for the impact of a change in center, we continue to see strong results, right, from 3 straight quarters of double-digit growth in China, being led by auto. In addition, we can talk about this, we've seen growth in the other parts of the China business, but the auto is continuing to lead.
Yeah, I've maintained for a long time, Joe, that as long as there is a market for high-performance technologies, that ADI's technologies would continue to be relevant, and that is the case. We see it in automotive, we see it in the industrial sector, the cloud, communications, and we're getting well paid for the quality of the technologies that we're bringing. So, it's clearly a competitive market, particularly
you need to go use the bathroom real quick,
mid-low
so I'm
ends.
gonna come back in a sec. Okay, nice. Stream is doing okay. Let's take a look. Nice. Yo, what's up, Allison? Thanks for tuning in. Okay, here go pee. I don't know why. Phone is screwed up. I can't even access my messages. I don't know why. Okay, let me just close.
With indigenous suppliers coming on stream, But given the high-performance thrust in our portfolio, we're getting rewarded for the capabilities that we bring at the system level for our customers.
Thank you, Joe.
Great, thank you.
Thank you. Our next question comes from Vivek Arya with Bank of America Securities. Your line is open.
Thanks for taking my question. Rich, just to clarify, what is that long-term model growth that you expect to return to this year? And then, Vince, my question is for you. You mentioned that the inventory levels have largely normalized. Is that at distributors? Is that at OEMs also? Does it apply to all end markets or mostly to industrial? Basically, how does that inform us about how ADI can feel about demand visibility and growth over the next handful of quarters? Thank you.
Yeah, maybe I can take the second part of the question first, Vivek. So we are seeing the normalization across the direct as well as distribution channels. And in pretty much every part of our business, including we were very, very encouraged by the recovery in industrial bookings. And that's a very, very important part of ADI's business. At its peak, it was a little over 50% of the total ADI revenue stream. So we monitor also, by the way, customer inventories, our top customers. So we see normalization across segments, across customers, both big and small. We've also, by the way, kind of a bellwether for the general base of customers, outside the top few hundred would be our mass market or a broad market. We've also started to see recovery there.
Yeah, and Vivek, when I talk about the long-term model, I'm talking about the published range of 7 to 10%, although I think as we've talked about, as the macros turn, I think there's opportunity for us to capture even more growth than that.
I think in your one-part, three-part question, Vivek, you talked about what do we think from here on kind of growth the back half of this year. I think what you mean by that is, how do we think about seasonality as you get to 3Q and 4Q? Again, this is not guidance for 3Q, but I'll give you kind of what we see as trends typically over the last 10 years for our third quarter. In our third quarter, industrial, auto, and comms are usually flat, plus or minus a little, depending on where you are in the cycle. Given what Vince was saying about industry normalizing, new wins coming on, I think those markets should be flat to up. So I think on the higher end of what normal seasonality is for those businesses. On the consumer side, we typically start your holiday build, which means you start growing 5-10% in 3Q. Now, there's obviously a lot of macro cross currents and really a cocktail of uncertainty out there on the macro side, which could mute second half. So we'll update you in 90 days what we really think about 3Q.
Okay, interesting.
Go to our next question, please.
Thank you. Our next question comes from Tore Svanberg with Stifel. Your line is open.
Yes, thank you. I had a question for you, Vince. ADI has a pretty unique position because of your hybrid manufacturing model. And I was just wondering, given all the political turmoil, the geopolitical turmoil that's going on right now, how are you thinking strategically about, that hybrid model? Because obviously, you're working with a very important partner in Asia, but then obviously also do some of your own internal manufacturing. So, yeah, how are you thinking about how this is going to play out over the next few years?
Yeah, thanks, Tori. Well, I think in times of great turbulence, diversity is a great benefit. Diversity of markets, diversity of products, diversity of customers and geographies. So I think, I feel good in terms of our ability with that diversity to solve two problems, essentially. One is diversity gives us optionality, but it also gives us resiliency. And, by the kind of end of 26 and the early 27, we will have secured at least dual sourcing for the entire product chain of ADI. So about 95% of the products, will have at least dual sources. And we've obviously desensitized geographic centricity over the last few years. We've invested in our fabs internally in America, in Europe. And we've worked with our partners as well to get at least 2 geographical sources for the products that we procure from our partners externally. So I think we're in a good position as a company to make sure that overall we have internally got twice the capacity we had at the start of the pandemic, and as I said, we've secured also additional supply in new sources, new fabs with existing partners. So I think we're in a very, very good position
Dual sourcing for the entire product
to
chain.
weather whatever turbulence might come our direction.
That's a great call. Thank you, Vince.
Thanks, Tori.
Thank you. Our next question comes from Chris Danley with Citi. Your line is open.
Hey, thanks, guys. I guess just to dig into the industrial strength, can you just talk about where that's coming from? Is this mostly inventory replenishment? Is it mostly improved demand? Is it both? And then, how did bookings trend during the quarter? Was the linearity pretty steady, or was there a spike, or just a little more color there would be great. Thanks.
Sure, Chris. I'll jump in on that. So on the industrial, if we take a step back, we've grown this business now sequentially for 3 straight quarters, off of what we said was our trough in Q2. And then as for Q2, we actually expect industrial to be the fastest growing market. So we feel pretty good that our recovery is taking shape and really could accelerate if the macro improved. For Q1 specifically, and we've talked about this in a couple of quarters, we saw continued strength in ADAF and in the automatic test equipment. And then what we started to see from a positive perspective is stabilization across automation, healthcare, and energy, which I think has been important. And then in Q1, one of the things that we've talked a bunch about on prior calls is watching for the pickup in the broad market. And we started to see some of that. In fact, the pickup in the broad market drove much of the upside relative to our initial expectations, which gives us confidence to begin shipping in line with end demand. So if you think about, we've talked about in prior calls that we took a significant amount of inventory out of the channel during 2024, about $300 million. Most of that impacted the industrial market. So as we look at our growth trajectory, shipping more to sell through into the channel will be a tailwind for industrial as well.
Yeah, as you know, the industrial sector is largely served through the distribution channels. So, with leanness there, demand recovering, I think both of those two concurrent streams are tailwinds for the company.
Yeah, on the booking side, bookings have improved industrial in 1Q versus 4Q, pretty much across all the areas, with the biggest strength obviously in AT and ADAS, as we talked about. And we think industrial will be our fastest growth market in 2Q, and that's supported by the bookings. Thanks, Chris.
Thank you. Our next question comes from Joshua Buchalter with TD Cowen. Your line is open.
Hey guys, thank you for taking my question. I wanted to follow up on the previous one. I think you mentioned the prepared remarks, inventory levels in the channel moved down, and I think they entered the quarter already below your 7 to 8 week target. Does either the April quarter guidance or the fiscal 2025 initial outlook of being in your target range
right now,
include any sort of channel?
Step back real quick. Hello. Hey, Pops. Yeah, I was wondering 你们今天还要吃饭吗？还是 Okay, sounds good. 现在就能来 if you're free. Yeah, I think 因为我6点有一个 I was gonna go to the gym. So, yeah. I am at the house. Yes. I'll see you guys there. Okay, thank you. I'll see you. I will go eat, Allison. You're still on here. Gonna eat with the parents. So really quickly, Biomarin stock. 6%. Let's go. Okay, Icon PLC stock. 2.45%. Okay, Biomarin earnings. I'm actually very curious because let's take a look. Let's go, Biomarin. PLC earnings release. Yeah, this is the most straightforward, no bullshit, gonna give you the numbers. No guidance though. Wait. Okay, so just key number of areas. Nice. Okay. Biomarin. It's good to see. It's good to see you in the green. Okay, so let's go back here to analog devices.
Refill and I guess what signals do you guys need to see before you would want to more clearly get back into that 7 to 8 week range? Thank you.
Yeah, so
Go ahead, Ray.
the current guide for Q2 has us shipping to sell through, so not adding into the channel. And I'll tell you, for me, for the benchmark, and we talk to our distribution partners pretty regularly, is if we're fulfilling customer requirements and we're not getting any escalations, we're feeling pretty comfortable right now operating below the 7 to 8 weeks we've had historically. You know, to balance that out, we're carrying a bit more inventory on our own books, which gives us some flexibility, particularly given the amount of the inventory we're carrying in die bank, which allows us to be quicker to respond. So near to medium term, I don't expect that we would be adding back to the channel, but we certainly do not want to go any lower.
Yeah, I think just add a bit of color to what Rich has said as well. The centralization of inventory management, I think, has served our customers.
I think before I even go any further, I kind of do want to understand this a bit, and gonna have to break out GPT on this. I'm reading through the analog devices. Devices transcript. Can you explain what replenish the die bank means? So the individual silicon chips that have been manufactured but not packaged. Mean they are stocking up on semiconductor dies before they are packaged into products. So this is kind of like a intermediate good. Days of inventory is measured and what channel weeks means. So I forgot how this works. So days of inventory is equal inventory divided by COGS. Okay. Ooh. It is holding more inventory. Refers to the amount of inventory held by distributors and resellers, expressed in terms of the number of weeks of supply they have on hand. So channel weeks is equal to distributor inventory divided by average weekly sales. Okay, gonna actually block out this real quick. I need to check something on my email. Okay. Confluence. Hey, 33, not bad. Insight Enterprises, Hubble. Okay, well. $73%. Oh my god. Okay, let's go back. Actually, let's take a look at GPT again. How by distributors and resellers express in terms of the number of weeks of supply they have on hand. Okay. Having lower channel weight suggests that ADI's partners are running leaner on inventory. So could be higher demand in end markets. Better pricing, distributors waiting on better pricing, shifts. Okay. Focus on direct. Okay. Should be more to sell through. So can you break down what CFO Richard is talking about here? Advanced driver assistance, okay. Sensors, radars, and cameras. So, I don't know, okay, I don't fully understand how that works when a company deliberately reduces inventory, channel inventory. Does 80, oh God, jeez. Does the inventory just sit on the company's book for ADI? Do they just store the inventory in a warehouse? I'm confused on how that works and why they could be limiting potential revenue by selling to a distributor. guess this is maybe a basic law of supply and demand that I frankly was glancing over. Real-time demand-based sales. Healthier sales cycles. Yeah, all of this sounds frankly limiting, taking inventory out of the channel. That could mean ADI is deliberately limiting 300 million in distributors to prevent oversupply, which would lead to price cuts and reduced demand for higher price products, ADI products in the future. So law of supply and demand. Okay. Nice. I like it, I like it. I think, what are they at right now? BioMarin is at 60? 65, yeah. It's pretty large upside. 1 year. 75 to 90. It's 30% almost. So you do have these very cyclical jumps, it seems like, in the stock price. Okay. Laws of supply and demand. More to sell through into the channel. Okay. So the current guide has us shipping to sell through, so we are not adding into the channel. So I guess that means they're selling directly. Selling directly to customers. ADI. not go any lower. Okay. Okay. Already have orders, I see. Okay. So ADI shipping to sell through could mean that ADI is shipping products to fulfill actual orders, distributors. A distributor sells an order for sensors. It's customers, okay. Sensors, which ADI will fulfill. Okay. Not adding into channel. Refers to ADI's positioning. Strategy to limit oversupply in the among distributors. They think it'll allow them to be smarter in their distribution, in their go-to-market, I guess. More flexible, respond to demand changes. Yes, will it though? Oh shoot, okay, getting a call. Hello? Hello? Yeah. Okay, okay. Yeah, sure. Alright, bye. Okay. Getting a call from mom. Oh shoot, okay. Oh wait. Hey, venture debt is seeing an all-time high. I wonder if that's helping Silicon Valley Bank. Okay. Okay, so I guess that is interesting. Channel weeks is already pretty low, 7 to 8 weeks. ADI does not want to go below that. Okay, so channel weeks again, I think is what is referred to as how much or how many weeks of inventory does a distributor have to actually sell to a customer. And it seems like they have about 7 to 8 weeks of inventory left on their books in order to sell, which is about a month and a half. So maybe a month and a half to 2 months. Yeah. Two months. But is fine with staying in this range. Okay. So I guess I'm gonna have to end the stream here, unfortunately. Thanks for tuning in. I wasn't able to get to the other stocks, Cadence Design and Wix. Yeah, that'll be in another stream. Allison, thank you for staying on. I appreciate it. #1 supporter. Good luck with work, and I'll see you soon, and I'll see you guys next time. All right, peace.